I've had people tell me something is a great business, but for me, I think the only way you can actually tell something is a great business is if you've looked through hundreds and hundreds of companies. And just to get into the definition of a great business, I'm defining this as something as a business which is in its nature is the strongest business. It's a 1 in 100 business which can provide a sustained competitive advantage, which can then generate outsized returns on its invested capital over a sustained period of time. So, and it should be in the top 1% category for that. That's how when I'm saying a great business, that's what I'm thinking about there. So when people tell me that they have a great business, I oftentimes think, well, how many businesses have you actually looked through to say that? I mean, for me, when I'm thinking about what great business is, I shouldn't have a list of 30, 40 that I'm aware of. When I've only looked at 40 businesses, I shouldn't have like a list of 20 because that's by definition, it's not great. So for me, I'm thinking about like what's the top 1%, what's the top maybe 2% of businesses, and then I'm trying to really understand the reason behind it. And generally, if it doesn't fit in that wheelhouse, I would probably just think, oh, it's a good business, but there's a difference, right? So a few things that I generally look for is, yes, you can say, well, have they got high returns on capital? But the thing is, if you can't explain the reason for the high returns on capital, it very may well be a good business, but how will you actually know? Um, because chances are it may not be. It may just be that there are cycle highs. It might just be a very cyclical business, and they're just the high of the cycle right now. So for me, I would need to know what exactly is driving those above average returns. So a very obvious example is with sort of Facebook or Meta. It's the network effects part of their business, in the sense that because of the way network effects work, there are very few competitors in this space, because effectively the more people use the platform, the more valuable the platform becomes, because there's more likelihood that the user has other people they know on that very same platform. That's very difficult to compete with starting out, particularly when there's already a default one in place. I mean, we've seen multiple attempts and nothing's really worked. And it's very difficult to break that virality effect. So as a result, they've got a sustained share. They've got pricing power there. They can then price those adverts very well. And then another thing that I think Facebook does very well, in particular to itself, is that they give you amazing analytics. Another reason why it's a great business is because traditionally with marketing, it was very difficult to justify the return on investment unless you had a significant like one-off program, and you can maybe see the spike in revenue from that sort of advertising program. Whereas with Facebook, what they've done very well is that they've actually had the ability to track the results of the advertising, and then as a result, what happens is that people can then justify spending more, because if you're making 3 to 1 on your money as an advertiser, and your margins are for 40, 50%, now it obviously varies in terms of revenue on your revenue, then that basically means that it is very profitable for you to continue just pumping those dollars through and just basically cycling your cash. And that's something that sort of allows Facebook as well to give it pricing power, because it can justify that, and it makes a more competitive marketplace. Whereas if I knew that, I can advertise with money, but I can't give an exact range, as an investor, I would, again, a marketer is the very same thing to an investor, because they're again making a decision on their return on spend, right? And so as an investor, as an investing marketer, I would then have to, discount that, because I need a margin of safety. I'm not sure whether the returns are, and I may not just be willing to invest as much, right? Very same here. So if I knew that a business is going to continuously grow 20% per year, versus a business that I think might grow 20% per year, but it's very up and down and there's no certainty about it, I'm going to be paying significantly less for that. So those are two characteristics that lend itself very well. It's an asset-light business as well. There's no real capital requirements. Now, they do have data centers and servers, and the employees, and the demand for people is very competitive. So you could argue that that they have to invest in this overly luxurious office space to then try and retain these top talent individuals. Yes, but overall their margins are very high, nothing as capital intensive as, for example, the trucking business or something like that. That's a great business. So others, you need to have a set few things which can generate, which can clearly to me define what the above average return is because of. Facebook above average return isn't coming from the fact that their people are significantly better than everyone else on the market, or that their branding of themselves is significantly better. It's just because of these 1, 2, 3 characteristics. Other examples that you can sort of think of as well, without using, if we sort of go as a business may have, for example, if we're talking a brand, it might have mind share, and that might be its thing where, for example, Nike has done it very well in basically asserting itself in terms of mind share, which just basically means that if someone was to think about a set number of brands in their head or the number of people that can recognize a logo, Nike has a very high percentage of the population that can recognize its logo. And then also they've done a very good job of positioning themselves with athletes and aspiring figures for these people who end up ultimately buying these shoes when they go to advertise. And that could consider its advantage, but again, it's very subjective on what I would call a great business. But generally, I'd want it to be the top 1% that can have sustained earnings over a sustained period of time, sustained increase in earnings over a long period of time. And I think Nike can qualify for that. Facebook more so, definitely. There are other significant sort of business models that can sort of justify that. A business I've recently been looking at, for example, is one where, without going into the names, it's a business model where they have basically 65% market share in their country of operations, and they basically operate a sort of a trio sort of business model, and they all sort of help each other out. And what I mean by that is that they have payments, they have marketplace, and they have banking all in one app. And this sort of lends itself very well because what then happens is that the payments makes the fact that you can use the marketplace significantly easier, because you don't have to worry about the payment methods. Their fees are very low. You're already familiar with that payment method. It's instantaneous, sort of how like eBay and PayPal partnered up in the day. And then if you look at sort of the marketplace itself, it lends itself very well to the banking segment they have, because it gives you this incredible set of data which you can then use to underwrite loan risk. So if you then say, oh, actually, on the platform I want to take out a loan, well, they're going to have much more accurate data than any other player, and clean data as well, where they can say, oh, we can see that you've been doing these transactions and that you've been spending a significant amount of your balance on food and these other accessories, and as a result we think that you've not got that much spending power left over, whereas someone that, for example, may have less transactions or relative to their income have less transactions, and you can see that buffer there, that's going to help them out very well when it comes to sort of loans, their habits as well, like are they frequently taking out these loans, are they frequently buying sort of trendy items which are often overpriced and indicate that they're often less disciplined with their spending. These sort of insights can be gleaned, and that also helps. Additionally, with like sort of first payment default rate, which basically just means that the first time so when someone takes out the loan, they're actually going to pay you the first time around, and not just take out the loan with no intention of paying, and just basically fraudulently take that money. Helps significantly with that, but then equally, because they have that, they're able to offer you a loan or offer you payment, offer you sort of like installment packages in terms of payments very conveniently, very quickly, without needing to go through all these background checks and everything, because it's all done on site immediately. And that again makes the payment proposition very easy. And then again, because of those features that you can't get anywhere else, that makes it more attractive for the merchant, which again, more merchants, more users, because of a wider offering. But then if we look at the payments as well, that's going to help the business because they can then easily cross-sell those people from the payments into the bank, which is because you may as well just keep your money there if you're already processing with it frequently and you're familiar with the platform. And again, that's going to help out the bank itself. It's just a very seamless network. I mean, and I think the fact that there's a lot of brand familiarity between them all gives a lot of trust in the entire sort of ecosystem. And that's, for example, one that I would personally class as like a great business because there's so much going on there. And also because there's so many, generally in sort of software in general, an insight that I've sort of learned early on is that the more uses a consumer has for a certain software, the more likely they are to stay and retain it long term. So, for example, if a business has a software offering they have, if a consumer actually, let's say they have 100 features, if that software, if the customer only uses, say, 6 of those features, that may be enough to keep them because they think, well, actually, I really like these 6 features and I'm going to use the app for that very reason, right? Or the software. But if you notice that, oh, actually, it's only got a limited number of features, it might only have 10, and they only actually need to use 2, well, then they might think, oh, actually, I'll just go and use. They're not as invested in it. Whereas if they went somewhere else, they could probably replace those 2 features. And some of those features can be very common, such as payments, banking. So it's just like having the more features that are actually built out and actually a very good quality is often very attractive in terms of retention as well, just keeping the customer in the ecosystem. Just very powerful because it's like once you get in there, you're basically sucked in there because you're using so many things all at once. For example, they have government services, etc. I'm not going to get too much into that business, but in general, my point is when I'm looking for a great business, so a top 1% business which is going to provide exceptional return on capital over time, I generally want to have studied significant volumes of businesses, hundreds if not thousands, and then of those I can then say, well, actually these are clearly the what differentiate it for me, and obviously I'll miss some as well because I'm not going to understand everything, but from what I can glean anyway, that's going to give me a lot better probability than me just having assessed 20, 40 businesses and gone, oh, actually, I think that these 10 are great businesses when really it's 1 in 4. Like maybe 1 in 4 are good, but that doesn't necessarily mean great.